Alrighty, well, welcome everybody. Thank you for joining us today for this 10 Steps to Financial Success webinar brought to you by the Credit Union of New Jersey. My name is Andrew Dauphney and I'm the Instruction and Outreach Librarian at the New Jersey State Library, and our presenter today is Jaime Gangone from the Credit Union of New Jersey. So everybody please welcome her. Before we get started, just a few housekeeping items to go through. If you do have any questions today, please submit them using the questions box in the GoToWebinar dashboard, or you can email me. My email is on the screen there. It is adauphinee@njstate.lib.org. You can submit your questions at any time, and we will be happy to answer them at the end of the program. There will be a survey that will be you'll be prompted to complete at the end of the webinar, as well as in a follow-up email. If you can please complete that, we would greatly appreciate all of your feedback. If you're looking for just some more information, the Credit Union of New Jersey has a wide variety and pretty deep trove of financial resources on their website listed on the screen here, and I'll make sure that as we get started, I'll send that out to everybody. So if you wanted to have the link, you will have that. The last thing I have is for those of you who may be new to GoToWebinar, this is what your dashboard should look like. If you do not see this dashboard currently, look for this orange box with a white arrow, either at the top left or right hand side of your screen, that will open and close the dashboard. And it's possible that the dashboard loaded closed on you. If you are running other programs as well, it's possible if you switch back and forth that you have GoToWebinar as a background program and you're not seeing it. Just look for the GoToWebinar icon, which is here probably down below in your taskbar, and just click on that and that should bring up everything for you. If you have any problems or struggling to figure anything out and not sure what to do, you can use this raise hand button here. Just click on that. That'll alert me that there's an issue and I will get in contact with you and hopefully be able to solve it for you. As I said, the questions box is right here. You can just type in your questions in this part here, hit send, that'll get sent to us and we'd be happy to answer it at the end of the program. So that is everything that I have for you. So I'd be happy to turn it over to Jaime.
Hi, everyone. My name is Jaime Gangone with Credit Union of New Jersey, and I'm just going to start the slideshow for you all. I hope everyone can see everything that I'm sharing on the screen now. Again, it's good? Okay. As Andrew said, if there's any questions, just place them in the chat, and after the webinar, we can pull them out and answer any of those questions for you. So today we're going to be talking about the 10 steps to achieve financial success. So financial success is described as being in control of your money. So therefore, income does not determine your success, but your choices and your priority does. So step one is to establish the goals. So there's actually a handout that goes along with this, and I'm going to actually share that with Andrew afterwards so he can send it all to you. And you guys can complete this on your own time. So there's a worksheet. It's a financial goal worksheet that you can work on your own time. So you might want to think about some of your financial goals as we're going through this. So to really achieve your goals, you have to prioritize them. And this can be done by identifying needs and wants and making spending choices with that specific goal in mind. You want to really make them measurable. So have a date in mind that you want to achieve these specific goals by, and know how much money can be applied to that specific goal on a monthly basis. So it's really important to be realistic. That proposed savings amount should be something that you're comfortable with, something that you can really afford to save weekly, monthly, every paycheck, whatever that is. You don't want to do something that's outside of your means. The other thing you should do is really set those goals for like a short-term goal, a mid-range goal, and then a long-term goal. So something short-term would be something that you need, significantly quick. Maybe that mid-term goal is saving for a new vehicle. You have a vehicle loan and you know it's going to be paid off in so many years, and you really want to save to be able to get a new car once that is paid off. And a long-term goal would be something like retirement, or if you have young children, that could be something like sending them to college. Okay, so step 2 is to take stock of what you own and what you owe. Everyone has a financial starting point, and it's important to determine really what that is. Some people owe more money than they own, and others own more than they owe. So looking at your personal finances and determining that will determine your net worth. So to know the starting point, you can complete a net worth statement, and that calculation is very simple. It's assets, what is owned, minus the liabilities, what is owed, and that equals your net worth. So again, there's a worksheet that goes along with this, and you can complete that after the webinar today once we get it out to you, so you can see what your net worth is. Okay, so step 3 is to create a spending and a savings plan, commonly called a budget. So I don't know if anyone has ever completed a budget worksheet before, or if you've ever developed a budget. Maybe some of you have a positive reaction when you hear this. Maybe some of you, think that this is not something that you've ever done and you don't want to do it. But it's really important to establish a budgeting, spending and savings plan, because it can be really good for you to tracking, your expenses and your income, and looking at that to see where you can cut and move some things around. So a spending plan and savings plan begins by analyzing your income. So again, there's an income worksheet that you can take a look at, and complete that at your own time. So once you complete that, analyzing the expenses comes next. So in order to have accurate figures, you want to track your spending for at least a month. So one thing I like to tell people to do is, if you're using, say you're using e-banking, you're using your debit card. Some people don't balance their checking books because you're not writing those physical checks anymore. You're just swiping that card. So a good way to manage this is to look back at your e-banking. You could see all of your transactions for a month. Some e-banking systems also have something built into it that it manages this for you. So we could show you what percentage of your income on a monthly basis is going where. So that's something, again, you guys can take a look at. So you want to at least track it for a month, but beware of like the budget busters. So those are expenses that can throw off a budget. So it might be something like an impulse buy, something, a luxury gift, a luxury item that you didn't necessarily need, but you bought it. Savings is really a key part of spending, the spending and saving plan. This includes having money set aside in an emergency goal, and saving for other goals as well, like we talked about the short-term, mid-term, mid-range goals, and then those long-term goals. So I typically tell people, if you don't have a savings developed, start with that emergency fund. A lot of us got the stimulus this year, most Americans did. So that's a great place that, you could have started developing that emergency fund or that short-term fund. So hopefully, if you do still have it, that's a great place to start your savings. Consumer debt is very expensive to hold on to. So planning for debt repayment is really, really important. Some people, when planning for debt repayment, use something called like a snowball method. So you start with the account that has the highest interest rate, pay that off, and work on to your next one. So along with a spending and savings plan, you need to develop plans to get that debt down as well. And there's an unsecured debt worksheet that is also included in that packet that I will get out to you. So you'll want to subtract the total of all expenses, including savings and debt payments, from the net income amount. And that's the bottom line amount that you are making on a monthly basis. So you want to make sure that figure is positive, because you don't want to be overspending what you're actually making. And there's a bottom line worksheet so you can see what that is equivalent to for you. Okay, so step number 4, live within your means. You really want to make a commitment to live within your means. So consider all the ways that income can be increased. So whether that's, maybe you need to pick up some overtime, maybe a second time or part-time job. But you also want to prioritize your spending. So you can't have everything you want. And this is, you really want to look at your needs versus your wants when you're going to spend. We talked about some of those splurging, spending that could really affect that bottom line, spending when you don't have it. So you want to reduce spending in areas that aren't important. You could substitute expensive items for inexpensive items. Possibly you want to postpone certain goals until they're actually affordable for you, and forego some expenses altogether if they're simply not affordable. So I know for myself, I was going out to lunch every day before COVID. I would go out to lunch every day just about, and I was spending, $15, $20 going out to lunch. So now I'm home, I'm spending a little more at the grocery store, but that grocery food goes a lot longer. So once you go back to work, possibly look at, bringing or packing a lunch to kind of substitute what you're spending on those expensive things and make it more affordable. Okay, so I was talking about this pie chart a little bit. Sometimes you can find something like this inside of your e-banking. At the credit union, we also have a tool like this that is built in so you can see where your money is going. And if you're using your debit card more often, this will be pretty accurate for you. So, take a look at this chart. The housing should be about 35%. So if you're paying rent, your taxes and all of those things kind of compile into that 35%. Savings, you should always be paying yourself first. So that's really important. And savings should be about 10% of that monthly income. Transportation should be about 15%. Outstanding consumer debt should be no more than 15%. And that's very important too when you're looking to borrow, you're looking for a loan, you're looking for an auto loan or a personal loan. Even if you're looking to do some sort of like debt consolidation, that number really factors in that debt percentage, because if you have a number that's a little too high, it can be really hard to consolidate debt and to get another loan. So you really have to be aware of managing that money. And if you are in a situation where you need to consolidate payments, the credit union or your financial institution is definitely a great resource to start with. We specifically have free certified financial counselors that can help. They'll do, a free analysis. We have some other tools online too. So there's different ways to manage that and to get that down. But all of the rest, including food, clothing, entertainment, childcare, medical expenses, contributions, and vacations should be about 25% of your income. So I touched on this a little bit. Pay yourself first. You really want to save for goals and just for financial security. Even having that emergency fund is extremely, extremely important. A recommended savings goal is to set aside at least 10% from your net income. So when I say pay yourself first too, if you don't have an account for savings and you're not putting money in there every paycheck, that's something you should really do and establish. So if you have some sort of direct deposit and an automatic deduction going into your savings account, that is paying yourself first. Everybody should try to set that up. Yes, you can always get to that money if you need to, if it's just a regular savings account, but it's really important if you don't have something set up like that, you should at least try to save, it says a recommendation of 10% of income. It can be difficult, but a good time to do that is if you get an annual raise or possibly you get an annual bonus. That's a fantastic way to start a savings and start building that. Again, if you got that stimulus money and it's still there, that's perfect to put and keep in a savings account to sit and grow and be there for an emergency situation. Okay, so we've touched on this a little bit. So the 3-tiered savings plan, So there's three different tiers of savings priorities. And I always say start small before starting big. Um, so the first thing you want to do is to establish a liquid savings account, and that's to be used for emergencies. So this should really equal 3 to 6 months worth of essential living expenses. Some people might want to save 6 to 9 months in tougher economic times. So this would be, a perfect time period to be a tough economic time. COVID happened. Some people had hours cut. Some people had lost wages, furloughs. There were many different situations. Luckily, I know some, financial institutions did work with their customers to assist during this difficult time. But if you had that emergency fund sitting there, you would have been able to sustain even though you might have been furloughed or had lost hours. So it's very important to keep that going in case of something happening. So medium-term goals is like semi-liquid. That's a 2 to 5 year savings. So this money could be put into a CD. Maybe you put it in a money market. Now CDs will hold and lock your money up for a specified period of time. Same thing with like an annuity. They're higher interest rates. You're earning more on that money, but it's really money that you can't get to. So when you're setting aside money like that, you have to know that you're not going to need it and have that short-term savings already built up. So a long-term savings is retirement and education. So if you have a 401k or a pension plan with your current company, lots of times they actually put in some sort of match for you. I always recommend if you have it set up, put in the max so you could get that max match because it's actually free money for you. It's very important to do that. And again, long-term savings, education, if you have a young child, maybe you're trying to go to school yourself and you're trying to build, some savings for that. Make sure it's an affordable amount that you're putting aside for those goals. Okay, so we're going to just touch on tax deferred and taxed investments. So you can see the growth over years over here. So you can see the tax deferred versus the tax investments. Okay, and you can see the tax deferred actually builds a little higher over time. So this chart shows the difference between a $250 a month contribution to a tax deferred account versus a taxable account. So assuming a 6% annual return and state and federal marginal tax rate of 30%, the tax deferred figures are the values in that account that do not reflect the taxes that will have to be paid after being withdrawn. It's actually good to have like a nice mix. If you have, maybe you have some sort of a Roth and you have a traditional, it's nice to have both. If you don't have something like that set up, or if you're looking to have something like that set up, make it a good mix for yourself. Okay, so you don't want to procrastinate. You really need to start now. Decide how much to put aside, have it automatically deducted from your paycheck or checking account and deposit into that savings or possibly some type of investment account. So compounding interest only works over a period of time. And keep in mind that achieving future goals is often worth spending a little less money today. So make that commitment. Don't wait if you don't have something set up already. Do it today, start now. Maybe it's next year when you get the raise, but make the commitment to do it and start saving for your financial future. Okay, so this chart here is experience through compounding interest. So it reflects a savings plan of $150 a month with a 6% annual return. Now, you're not going to see this type of interest on a savings account. This is going to be something that you would see with an investment, possibly an annuity, probably not even a CD at this time because the rates in the market are very low at this time. A lot of people have a higher amount of assets, and that affects the savings rates. So some people are holding on to their money because they just don't know what's going to happen. So you're seeing that rate fluctuation at this time. The credit union does have a high rate savings account. It's 7.5% on the first $500. And we actually established this account because we saw that most Americans don't have $500 in a savings account. So it only earns that interest on the first 500, but it's trying to encourage people to save that might not have a savings and might not have money built up. So it's a great opportunity if you don't have something, and if you have a credit union account already and it has some money sitting in it, it's a great account to open and transfer some funds into. I know we have some state workers on here that may be using the credit union, so I just wanted to touch on that. Okay, so step 6 is to delete your debt. So a lot of people rely on credit to make ends meet. And if you do, if that's you, you might want to start to live on a cash-only lifestyle. So it's really impossible to get out of debt if you're constantly charging something. So when you're constantly using that charge card too, interest in that financing expense can make the debt seem like a heavier load. So if you are in that position and you are constantly using a credit card and you're not paying it off month to month, you might want to call your creditors and see if they can work with you and reduce the interest rate on, some sort of temporary basis. This way that could reduce your payments and help you to pay it down a little more. If you are only paying the minimum, you are never going to see that debt disappear. It's really going to drag out over, a longer period of time, and you're going to be paying possibly double or triple what you actually bought the item for because of that interest compounding and building. So my suggestion is, if you're in that situation, again, increase your payments, do the most you can afford. I talked a little bit about snowballing your debt payments. So if you have a couple different things revolving credit that you have balances on, start with one, start dumping extra money into that to pay it down quicker, move on to the next one. So look at the ones that have the highest interest rates, pay that off first, and then you're going to want to move on to the next expensive debt. Now, you don't want to stop making payments on anything ever. You want to continue making payments on those other things, but start dumping more into that higher interest rate so you can pay it down quicker. So some debts are better than others. So good kind of debts are for things that increase value in your life. So maybe it's a home, business, or your education. And bad debts are things that can decrease in value. So clothing, meals, and vacations. You're not really getting anything out of that. It doesn't add anything into your assets. So that's the difference between bad and okay debt. So step 7 is to become a homeowner. So a home is a great investment. Over time, most houses appreciate in value. Right now, we're actually seeing that happen across the board for probably the first time in a long time. So the housing market is booming right now. If you are looking to sell a home, it's a fantastic time to sell. Lots of homes, they're finally getting back, what you paid for these houses. I would say 10 years ago, 2008, 2007, 2006 time period. So a lot of people are putting their houses on the market, selling them for a lot more than what they bought them for, but it is difficult to purchase. So there's not a lot on the market. So people are, getting into bidding wars and things over homes. But if you are looking to sell, right now is a fantastic time. So as a homeowner, you're entitled to significant tax breaks. Interest paid on the mortgage and property taxes are tax deductible up to $250,000 of the profits from the sale of the profits of the sale of the home are exempt from tax. So, and this is doubled for married couples. It's never too early to start planning. Most lenders do require a down payment, and to get a mortgage with a low interest rate, you do want to have a good credit score. So make sure your credit's in place. You want to make sure your debt to income ratio is in place. in a good place. This way you can get the lowest interest rate possible on your home loan. So step number 8 is to diversify. So you really want to diversify your investment portfolio. I kind of touched on this a little bit with the different types of IRAs and retirement funds. So with each investment, there is risk. So you always want to weigh the potential for risk against the potential for return. Having a mix of stocks, bonds, and cash offers growth and security. So stocks are shares of stock. They represent ownership in it or interest in a company. So you buy shares with the assumption they're going to increase in value, and then you can sell them eventually at a higher price. So bonds, it's a government loan to a company or government. It's a loan to a company or a government. You buy them for a promised rate of return. And then cash equivalents are very low risk investments such as CDs and treasury bills. Mutual funds are also a good way to diversify. So these companies purchase a mix of stocks, bonds, and cash equivalents, and then sell shares to the public. So it's always good if you do have some sort of investment portfolio, you'll want to talk to your investment advisor and see how you can diversify your portfolio. Right now, the market is fluctuating a lot. So if you do have something, you want to sit tight and ride it out. Don't do anything, especially if you have, some years to retirement. Don't do anything risky. Just kind of leave it as it is and let it ride out at this point. Okay. So over time, stocks have provided the highest rate of return, then bonds, then cash. So here's just a little picture of that. If you're looking at the screen, you can see the rate of return annually for each of these. And again, this is, varies depending on the market. And right now we're, it's kind of a rocky wave that's happening. We do have an investment service person at the credit union. Her name's Brittany. She's done a couple webinars recently for the credit union. So we're always looking to educate and teach people about what they can do. All right. So step 9 in the plan is insurance. So health insurance obviously covers your medical expenses. You want to have health insurance, of course. Most employers offer some sort of health insurance plan, and you want to make sure your whole family is protected adequately. So there's disability insurance, which protects your income if you can't work due to illness or injury. Life insurance protects loved ones with income replacement if you are to pass away. There's liability insurance that protects you from financial loss due to a lawsuit against you. And often, that's built into a homeowner's insurance as well as auto insurance. A minimum of auto insurance is mandatory, but you might want to add something a little more for greater protection. Renter's insurance protects your personal property against fire, theft, and other loss. If you are a renter, a tenant, you always want to have some sort of insurance. God forbid something happens. A lot of people don't think about it. If you're renting a home, the homeowner always has insurance for that rental property, but you should think about having it for yourself as well. And then homeowner's insurance is required if you have a mortgage. But even if you don't, it's important because your home is probably your most expensive asset, and you want to make sure you're protected if something, fire, theft, weather event is to happen. You want to make sure that income is there to protect you to rebuild. So this is part 2 of step 9. It's estate planning. So if you don't have a formal will drawn up, you can do this yourself, through some programs online, or you might want to have an attorney do it. You're going to want to determine an executor. That's the person who would administer the estate and distribute the assets. Decide on the distribution. So who's going to get what? If you have children, you might want to leave them something, or grandchildren, siblings, whoever it might be. Choose a guardian if you have minor children. If you don't, the state would decide for you, unfortunately. Include a residuary clause to cover the leftovers of your estate that you didn't specifically mention. When you form a trust, you transfer assets to another person, the trustee, and the trustee then manages and controls this asset for the benefit of a third person. So maybe it's a child, a young child, and you have that trustee until that person becomes of age. So a trust can ensure that people you love are provided with an income stream after you die, as well as protect the money from some taxation. So if your estate is large, a trust can be a good idea. Document wishes for life-saving measures, so your loved ones know what you want to have happen if you become incapable of making those decisions. These are all things that can be really difficult to talk about, but you might want to have a plan in place for a crisis. And that way you know your loved ones are ultimately protected if something is to happen to you. So step 10 is to get help when you need it. So professional assistance for money matters is, extremely important. You'll want to go to a financial institution that you feel comfortable with. Most of them have financial planners. Again, it doesn't have to be your financial institution. If you want to use a different financial planner, again, somebody that you're comfortable with, somebody that you trust to make a decision in your best interest. There's also estate planners, and they're usually attorneys, and they can assure that your financial wishes are met. So the internet is a great tool for you to do learning on your own. Workshops like this, financial planning books and magazines can also assist. Again, we have some tools and resources on the credit union's website. So if there's anything that you're looking for, I always tell people, look for something, a free service first. Don't pay, if you need help with debt consolidation or debt management, paying things off. Don't go to a company. See if your financial institution offers something, the credit union does, and see if you can really navigate this first free without spending any money on anything. So an investment in knowledge always pays the best interest. So I want to thank you all for coming today and attending the webinar. I'd be happy to answer any questions anyone has in the chat. I don't know if there's anything in here yet.
Yeah, we have a few questions that have come in.
Okay.
So, well, we can get started. Do you recommend the 50-30-20 plan? Why or why not? And where does charitable giving fall under the 50-30-20 plan?
So I don't know that I'm familiar with the 50-30-20 plan. I'm assuming that's some sort of savings plan. I don't know if I can see the chat either. Okay, so I'm not sure if somebody can elaborate on that, whoever asked the question, the 50-30-20 plan. I don't know if it's a savings, giving, budgeting type of plan that, you might be using. But, according to, our thoughts, it's 10% of savings income you always want to save. So you want to have some money going into a savings account, 3 to 6 months of savings built into an account. So if whoever could elaborate a little bit, that would be helpful.
All right. While we wait for that, please explain the money market funds versus the money market savings accounts.
So a money market is liquid cash. You can access that cash at any time. Some money markets offer checked writing ability. And money markets, you can always get that money out. Now, they're typically tiered with interest rates depending on the amount that you have in there. And it was money market savings versus money market.
It was. It was just money market funds versus money market savings.
Okay, so I believe they're the same thing. With the money markets at the credit union, it's one account. it's a savings, the checking, or there's checks tied to it. So again, it's tiered interest rates. It's liquid money. It's not tied up. It's not locked up like a CD that you have to leave it in there to earn the interest. You can withdraw from those types of accounts, but they typically earn a higher interest rate.
All right. Two follow-ups for the current question. The money market funds are investments, not account deposits, is what they're.
No, money market are deposit accounts. They are not an investment account. A mutual fund is an investment account. Maybe you're thinking of mutual funds, but money markets are not investments. They are a higher rate savings account or higher rate account. You'll earn more, but you also have to have a higher balance in that type of account. It's typically required of a higher balance to open, a higher starting balance. I believe ours start at $200.
All right. The 50-30-20 plan, I guess, divides the categories into 50% for needs for your take-home income, 30% for wants, and 20% for savings and debt repayment.
Okay. I've never heard of that type of specific plan. I think 30% on wants sounds, pretty high for income. I would probably reduce that, especially, and I mean, even the needs. So you really want to break it down into, housing and things you need for survival every day. And then those extra things, the wants, needs are necessities. Wants are the extras. So, I think you need to look at the categories in each of those.
All right. How do you feel about gold and silver?
Gold and silver, like cashing it in?
Probably more like investing
Investing?
I think in
So
the commodity.
okay, I am not an investment. I'm not a licensed investment advisor, unfortunately. So I don't know how to answer that question. If you would like to send me an email, I can, put you in touch with our investment services person. Her name is Brittany. My email's up on the screen on the last slide if you can still see the screen share.
Mhm.
But if you would like to send me an email, I can have her touch base with you regarding that.
Okay. Where is the best place to research selling your first home after 27 years and they're looking retirement is about 8 years away?
So, the internet is a great resource. If you have a realtor, maybe a friend or a family member, that might be a great person to touch base with. If you've owned the home for a long time, I don't know if you've been updating it or, maybe it needs some different types of updates. If you're looking to put it on the market, you definitely want to touch base with a realtor. They would come in and they would kind of make some recommendations for you, help you stage the home for sale. So I would say a realtor, or, if you don't want to go that route yet, just looking online for some tips for selling a home.
All right. Are all of these recommended percentages per month based on the net or the gross salary or income?
Net.
All right, so to open a credit union account, do you have to be a state employer or can anyone open an account?
So anyone can open an account with the credit union. I can assist you with that. There's a number of employers that we work with, and we also work with people that donate to the foundation, the Credit Union of New Jersey Foundation. You can become a member through there with a $5 donation. Also, our Lafayette branch is not open at this time. If any of you are, residents in the area or state workers, our Ewing branch is open by appointment only, and the drive-through is open there as well. But we have lots of services online, so you can access your accounts and apply for loans, apply for membership, and things like that.
How do you make a deposit into the account, or do you transfer money from your current account? I'm not quite sure.
So if you are, if you're a credit union member, you can have payroll going into the account automatically. The drive-through is available for you to make deposits as well. You could do an electronic transfer if you have another account that you would like to fund your credit union account with. So you can transfer funds from one into the other. Even if it's with another financial institution, you could set it up like a bill pay. Once you're a credit union member too, we have a mobile app, and you can do check deposits from the mobile app. So you could always take a picture of a check and deposit it as well. So there's a number of ways you could get funds in there.
Yeah, it looks like it was specifically related to that they have a credit union account, but they also have another bank account. But I think you touched on that, you can transfer between.
Yeah, you can transfer funds.
Okay. Do you have the average interest rate on a line of credit?
I don't know what it is at this time. I want to say it might be like 4.99. Well, a home equity line of credit or a personal line of credit, because that's also going to vary on rate as well. So if you could tell me which type of line you're looking at. So on a home equity, the lowest rate is 5.24% for a 5-year term.
It looks like, yeah, it's personal line of credit. They just
Personal. So we have something that's called a lifestyle loan, and those rates are actually fantastic. But that's a term loan. So for 36 months is 6.24. If you're looking for a personal line, those rates are a little bit higher. If you are a state employee, you're eligible for the Perks at Work program, or if your employer partners with the credit union, you're also eligible for a loan discount as well. So we can definitely help you with that. I believe it's an 8.99 for just a regular line.
I would like to refinance my mortgage, but I have 3 unpaid debts. Should I wait to improve my credit score? It's currently 653.
And you're looking to refi? Well, right now is a great time to refinance. So, I don't know if you know what your debt to income ratio is, because that's definitely going to factor into the refinance. So you might want to kind of look at your debts and your income and do a little analysis on that. But it's a fantastic time to refinance. The rates are extremely low, probably, lower than they've been in a couple of years, because they did start to creep back up a little bit over the past few years. But now that the housing market's looking a little different, the rates are extremely low. So it's a really good time to refinance if your debt to income ratio is okay.
Right. How would you go about doing that debt to income ratio?
So you need to calculate your outstanding debts. If you have unsecured debts, you need to calculate that with, that housing expense and your income. And that will get you a ratio. It will get you a percentage of monies owed that you have outstanding with unsecured and the secured debts versus the income you have coming in. And you really want it to be under like well under 40%. 40% is like a higher debt to income. So it does make it a little more difficult to get a loan when you're up that high, because you still need money to pay for those everyday expenses, and creditors want to make sure there's enough there for you to afford expenses. When you apply for anything, any type of loan, that number is ran. So it's really important, you know, that ratio is at a good amount. Any other questions?
That seems to be everything. We can give it a moment or two in case anybody thinks of anything.
Yeah, if anyone has anything, you know, feel free to ask. If it's something that you don't want to ask with the group, you can always email me and I can assist. I did put links if anyone's interested in emailed information, links to the website. We have some financial tools. I see that in the chat, the link in the chat to the credit union's financial resources page. So you can find some great things there. Andrew, I'm going to send you the handouts if you want to send it out to the group.
Yeah, I'll make sure I'll write up a recap and include all the handouts, the links, your contact information, so everybody will have that.
And then we also take one-on-one appointments if anybody has a question, or if anyone's a credit union member and you want to ask something or, you know, change something on your account, we can definitely help you with that. You know, we might have some members online with us.
All right. With the personal line of credit, is it simple interest?
Simple interest? Is that what you said?
Yeah.
So it is a set interest rate. It's not a fluctuating interest rate. It's going to be set, if that's what you're asking. And if you're looking for additional info, again, you can, if you want to email me offline, I can send you the link to that page on the web and you can take a look, you know, at that. And we have some different types of personal loans. So if you're, you know, if you're looking to consolidate with that line, some people like to add a line on to their checking accounts. If they overdraft their checking account, it goes to and pulls from their line of credit. So there's different uses for it. And typically, you know, they're asked like what the purpose is of the line and whatever. So there might be like a different product or service that might be special for your situation.
All right.
Anyone?
Well, I don't see any more questions, so I think we can end it there. Thank you, Jamie. Thank you for everybody attending. Again, look out for my recap emails that I always send out. It'll have everything that you need. Be safe, be well, and hopefully we'll see you again soon.
Thank you so much. Have a good one.